Are you unknowingly sabotaging your TFSA? Making the wrong moves with your TFSA can cost you thousands of dollars down the road. The good news is that most of these mistakes are easy to fix, often in just 10 minutes. Here are the 9 big TFSA mistakes you need to avoid, starting with naming a beneficiary instead of a successor. Now, this is the easiest mistake to correct in this entire list, but also one of the most impactful. If you're married or in a common law relationship, you need to name your spouse as a successor holder for your TFSA, not just the beneficiary. Here's an example to show why. Let's say Jack has a TFSA with $100,000 in it, and he names his spouse Jill as a beneficiary. When Jack passes away, Jill inherits $100,000, but the TFSA is closed. Now, Jill has to transfer the funds to a non-registered account, and any future gains on that $100,000 are subject to tax. Also, the TFSA contribution room is lost forever, so future growth isn't tax sheltered. If Jill earns a 5% return on that money annually, she could owe taxes on $5,000 of gains each year. But if Jack names Jill as a successor holder instead, she will take over the TFSA completely. The $100,000 stays in the TFSA, and any future gains remain tax-free. Jill's own TFSA contribution room is unaffected, meaning she can continue contributing to her own account while benefiting from the tax-free growth of Jack's TFSA as if it were her own. So going back to that example, if Jill earns that same 5% return on $100,000, she won't owe a cent in taxes on the $5,000 annual growth, keeping her money working harder for longer. So how can you fix this? It's super simple. Contact your bank or TFSA provider and ask to update your account, naming your partner as a successor holder. This 10-minute task could save your loved ones from losing out on significant tax-free growth. Next mistake is not coordinating your TFSA with your overall financial picture. Not coordinating your TFSA with other accounts like your RRSP and CPP can lead to missed opportunities and less efficient tax strategies. While the TFSA is flexible and powerful, treating it in isolation could cost you in the long run. For example, if you're in a high 35% tax bracket, contributing $10,000 to your RSP instead of your TFSA could save you $3,500 in taxes right now. That RSP tax savings can be reinvested, growing your wealth, or even reinvested in your TFSA. In retirement, when you're in a lower tax bracket, say 20%, withdrawing from your RSP would cost much less in taxes. Similarly, delaying your CPP from age 60 to 70 can boost your monthly benefit from around $640 to $1,420. Using TFSA withdrawals during that period can cover the income gap without increasing your taxable income, keeping you in a lower tax bracket and avoiding the OAS clawback. I've worked with a lot of clients who were focused on maxing out their TFSA but overlooked their RRSP, and once we crunched the numbers, we found out they could have saved thousands more in taxes by balancing contributions between both accounts. At Blueprint, we run different scenarios to help clients optimize their financial plans and answer key questions like, should I prioritize my TFSA or RRSP? And what's the best withdrawal strategy for my TFSA to maximize my overall estate? It's all about finding the right mix that works for your long-term goals. The next mistake is swinging too hard for the fences. And by this, I mean being too risky in your investments. I see this a lot, especially with younger clients eager to hit it big. They want to go all in on high-risk investments like meme stocks, cryptocurrencies, or penny stocks, hoping to double their money overnight in their TFSA. But here's why this approach often backfires. These types of investments are incredibly volatile. Even if you manage to double your money in a year, would you really have the discipline to cash out and move it into something safer? Probably not. You'd likely let it ride, exposing yourself to even bigger risks. The more you gamble, the greater your chances of losing big. The late Charlie Munger, who was Warren Buffett's longtime business partner, wisely said, "The big money is not in the buying and selling, but in the waiting." If you're investing for the thrill of it, that's one thing. But if your goal is to secure your financial future, you need a strategy that balances risk with reward. Let's say you contribute $10,000 to your TFSA and put it into a high-risk investment. If it drops by 50%, you're left with just $5,000. The worst part, in the TFSA, you can't claim that loss on your taxes, and you don't get back the contribution room. That lost space is gone forever. reducing your future tax-free growth potential. Instead of building wealth, you've dug yourself into a hole that's much tougher to climb out of. The key here is balance. It's fine to take some risks, but don't swing for the fences with everything. Slow, steady, and consistent growth may not sound thrilling, but it's the smartest way to build real wealth over time. I go into this in way more detail in another video I made about how to build a $1 million TFSA over time, so check that out. The next big mistake I see is investing in a TFSA before paying off high interest debt. I saw this mistake a lot while working as an advisor at a bank. It might seem like a smart move to start investing your TFSA right away, but if you're carrying high interest debt like credit card balances, it's better to deal with that first. Think about it. Credit card interest rates can hit 20% or more. It's incredibly tough for any investment to consistently earn returns that high. Those types of returns are reserved for elite investors. For example, Warren Buffett through his company Berkshire Hathaway has delivered an average annual return of around 20% since 1965. By focusing on paying off high interest debt, you're effectively earning a 20% return on your money. Not only does this save you a ton on interest payments, but it also puts you in a much stronger financial position. Once that debt is cleared, you'll have more freedom to invest without the burden of high interest payments hanging over you. Take a step back, assess your debt situation, and consider redirecting funds towards paying it off. Once you're debt-free, you'll be able to invest more effectively and watch your TFSA grow without worrying about interest draining your hard-earned money and growth. Now, the next big mistake that I often see that I also think is one of the most insidious because of how harmless it seems, is using your TFSA as just a savings account. You might think that keeping your money in a savings account is a smart move in your TFSA. While it's safe, this approach can actually hinder your wealth growth. Inflation gradually erodes the purchasing power of your money, meaning your savings might not keep up with rising costs over time. And that's especially true if you keep it in a big bank's savings account, which has very, very low interest rates. Instead, consider investing in equities like stocks or bonds within your TFSA. These investment options have the potential for higher returns, helping your money grow more effectively. For example, if you invest $10,000 at a 2% interest rate, after 20 years, you'd have about $14,859. But if you invest the same amount with an average return of 5%, you'd end up with approximately $26,532. That's a substantial difference that can significantly impact your financial goals. If you must invest in a savings account, I highly recommend doing a high interest savings account, something like what EQ Bank or Wealthsimple offers. Next up is ignoring foreign dividend taxes in your TFSA. But before we get into that, please like and subscribe to the channel if you're finding these tips helpful. Ignoring foreign dividend taxes in your TFSA. Investing in foreign assets like US or international stocks through your TFSA might seem like a great move, and it usually is. But many people overlook the impact of withholding taxes on your dividends. Some countries like the US impose a 15% tax on dividends paid to foreign investors. While your TFSA is tax-free in Canada, it's not recognized as such internationally, meaning you can't recover that 15% tax. For example, if you earn $1,000 in dividends from US stocks held in your TFSA, $150 of that will be automatically withheld, and there's no way to get it back. Over time, that can eat into your returns. It's important to note that this withholding tax applies only to dividends, not capital gains, so it's not as bad as it might sound. Investing in US stocks are still beneficial in my opinion, but if you have room in your RSP, it might be a better place for your investments. Due to tax treaties, RSPs often allow you to avoid or reclaim withholding taxes on foreign dividends. Another really simple workaround is if you really want to still invest in US stocks in your TFSA, consider holding mostly just growth stocks that don't pay dividends at all. And that still will be completely tax-free when you sell it. Next up, I want to talk about all the overcontribution mistakes you can make and some of the gotchas you might run into. Overcontributing to your TFSA can quickly lead to huge penalties. Any amount over your TFSA limit gets hit with a 1% monthly penalty on the excess. And fixing it often means withdrawing the overcontribution and potentially having to negotiate with the CRA, which wastes a bunch of time. So here are the 3 common gotchas that I see people making when they're accidentally doing an overcontribution mistake. And this first one I made myself is trusting the CRA's contribution limits. The CRA's website may not always reflect recent transactions, which can lead to accidental contributions. So what happened to me one year was I wasn't sure how much I contributed, so I logged into the CRA website and I saw that I still had $5,000 of room left. But it actually didn't account for the $5,000 that I had put in already, so I was actually at the limit. I did end up over-contributing and did have to pay a penalty at the end of the year, which I wasn't happy about. But it was an important lesson learned. And for me, that lesson was it's much better to keep your own records, whether it's a spreadsheet or just a quick note on your phone, so you know exactly how much room you have left. The second mistake that I often see is recontributing in the same year. If you withdraw money from your TFSA and then recontribute it in the same year, it doesn't reset your contribution room. The room from withdrawal isn't restored until the next calendar year. So if you're at your limit and you contribute too soon, you could face penalties. So it's best to wait until the following year to recontribute. The third big mistake I see is not transferring investments in kind. When moving investments between accounts, selling them first can lead to overcontribution issues if you redeposit the money into your TFSA. To avoid this, you can transfer the investments in kind without selling. But even then, you need to be cautious about timing to avoid unintentionally reducing your contribution room. All right, the next big mistake I see is not understanding the technical side of the TFSA. A lot of people miss out on the full potential of their TFSAs by not fully understanding how it works. Here are a few key points to keep in mind. The first one is knowing exactly what you can invest in. Not all investments are allowed in a TFSA. Some private or foreign assets, for example, might be prohibited, and investing in them could lead to penalties. Here is an overview of the CRA's list of permitted investments. I'll leave it on the screen here for you. And a little research can save you from some costly mistakes. Next is to understand that gains and losses don't impact your contribution room. There is a common misconception that investment gains or losses in your TFSA affect your contribution room. The truth is that they don't at all. Your room is only based on your deposits and withdrawals, not how much your investments perform. Whether your investments skyrocket or dip, your TFSA limits remain unchanged. That means you can focus just on the contributions and the growth without worrying about affecting your contribution space. Next is realizing you're not limited by your bank. Many people think that they have to stick with their bank's investment options for their TFSAs, but that's just not the case. Oftentimes they're going to put you into these high-cost mutual funds. You can explore platforms like Questrade, Wealthsimple, or EQ Bank, which often offer more options and at lower fees. Taking the time to shop around can improve your returns and broaden your investment choices. Avoiding TFSA pitfalls is key to growing your savings. Visit our website for the full article about this video and learn how we can create a personalized plan for you. Like, subscribe, and check out our next video on boosting your wealth.